I'm reading debt cancellation and debt suspension agreements out of the new text for the reference guide to regulatory compliance. I'm on PDF page 94. It should take less than 15 minutes. In 2002, the OCC issued regulations for the purpose of providing consumer protections in the purchase of debt cancellation contracts and debt suspension agreements. Debt cancellation contracts and debt suspension agreements work to cancel or suspend a consumer's debt on the occurrence of certain specified events. National banks have had the authority to enter into these types of agreements, but until issuance of these regulations in 2002, there had been no consumer protection and safety and soundness requirements. The regulations became effective in June of 2003. No comparable regulations exist for state-chartered institutions or thrift institutions. Coverage, Subpart 1. National banks that issue debt cancellation contracts and debt suspension agreements with borrowers in connection with loans for personal, family, and household purposes. Letter B, under coverage, debt cancellation contract. A DCC is a loan term or an arrangement that modifies a loan term under which a bank agrees to cancel all or part of a customer's loan obligation on the occurrence of a specified event. The DCC may be included as a part of the loan documents, or it may be a separate agreement. Debt suspension agreements, DSA, is a loan term or an arrangement that modifies a loan term under which a bank agrees to suspend all or part of a customer's loan obligation on the occurrence of a specified event. The DSA may be a part of the loan itself or a separate agreement, and does not include a loan payment deferral arrangement where the borrower or the bank can unilaterally defer a payment. The requirements, section 2, discusses A, prohibited practices, including anti-tying. A national bank cannot extend credit or alter the terms of an existing credit conditioned on the customer's agreement to enter into a DCC or a DSA. 2. A national bank may not engage in any practice, including advertising, which would cause a reasonable person to be misled with respect to DSAs and DCCs. 3. A national bank may not offer DCCs or DSAs that contain any of the following terms. A term that gives the bank a unilateral right to modify the contract unless the modification is favorable to the customer and is made without a charge, or the customer is notified of the proposed change and is given a reasonable opportunity to cancel the contract without penalty before the modification goes into effect. And B, in a residential mortgage loan, a term that requires a lump sum single payment for the contract payable at the outset of the contract. Subpart B under requirements is refunds. If a DCC or DSA is terminated, the bank must refund any unearned fees paid for the contract unless the contract provides otherwise. 2. A bank may offer a contract that does not provide for a refund only if the bank also offers the customer a bona fide option to purchase a comparable contract that does not provide for a refund. And 3, refunds must be calculated by a method at least as favorable as the actuarial method. C, under requirements, titled Payment of Fees. Except in a residential mortgage loan, a bank may offer a customer the option of paying the fee for a single contract in a single payment, provided the bank gives the customer a bona fide option to pay the fee in periodic payments. Note, the OCC delayed indefinitely the effective date of the requirement to offer a periodic payment option in transactions where unaffiliated, non-exclusive agents of national banks offer DCCs and DSAs in connection with closed-end credit. Subpart D, disclosures under the requirements section. Timing of disclosures. You have A and B, short form and long form. C, telephone. D, mailed solicitations and take ones. E, e-sign. Under short form, A bank must make the short form disclosure orally at the time the bank first solicits the contract. B, long form, a bank must provide the long form disclosure in writing before the customer completes the purchase of a contract. If the solicitation occurs in person, the long form disclosures must be provided at that time. Telephone transactions. If the contract is solicited by telephone, the short form disclosures must be given orally and the long form written disclosures must be mailed within 3 business days, beginning on the first business day after the solicitation. D, mailed solicitations and take-ones. If the contract is solicited by mail or through the take-one applications, the bank may provide only the short form disclosures in the written materials, provided the bank sends the long form disclosures to the customer within 3 business days of the customer's response to the solicitation. E, disclosures may be provided in a manner consistent with e-sign. 2, form of disclosures. Disclosures must be readily understandable and designed to call attention to the nature and significance of the information provided, including use of plain language headings, easily readable typeface and type size, wide margins and ample line spacing, boldface or italics for key terms, and distinctive type style and graphic devices such as shading or sidebars when the disclosures are combined with other information. B, disclosures must be meaningful. Number 3, content of disclosures. See A and B of the appendices. The short form disclosures must include the following as applicable: notification that the product is optional, lump sum payment of fee with no refund, refund of fee paid in lump sum, requirement for additional information before payment is made, and eligibility requirements, conditions, and exclusions. The long form disclosures must include the following as applicable: notification that the product is optional, explanation of debt suspension agreement, amount of fee, lump sum payment of fee with no refund, refund of fee paid in lump sum, use of card or credit line restricted, termination of product, eligibility requirements, conditions, and exclusions. And 4, the content of disclosure advertisements. Short form disclosures are required in advertisements and promotional materials unless the advertisements and promotional materials are of a general nature, describing or listing the products or services offered by the bank. And E, affirmative election to purchase a contract. Before entering into a contract, the bank must obtain the customer's written affirmation election to enter into the contract and written acknowledgement of the receipt of the disclosures. 2, telephone solicitations. If the sale of the contract occurs by telephone, the customer's affirmative election may be oral, provided the bank A maintains sufficient documentation to show that the customer received the short form disclosures and then affirmatively elected to purchase the contract. B, mails the affirmative written election and written acknowledgement together with long form disclosures to the customer within 3 business days after the telephone solicitation and maintains sufficient documentation to show it made reasonable efforts to obtain them from the customer. Or C, provided the bank permits the customer to cancel the purchase of the contract without penalty within 30 days after the bank has mailed the long form disclosures. 3, mailed solicitations and take-ones. I think this is still the content of the disclosure section. If a contract is solicited through the mail or by a take-one application and the bank provides a short form disclosure in the written materials, then the bank must mail the acknowledgement of receipt of disclosures together with the long form disclosures within 3 business days after the customer responds to the solicitation. B, the bank may not obligate the customer until it receives the written acknowledgement of the receipt of disclosures unless the bank maintains sufficient documentation to show it provided the acknowledgement of receipt of disclosures to the customer. 2, maintains sufficient documentation to show that the bank made reasonable efforts to obtain a written acknowledgement of the long form disclosures. And 3, permits the customer to cancel the purchase of the contract without penalty within 30 days after the bank has mailed the long form disclosures. And number 4, electronic elections. The affirmative election and acknowledgement may be made electronically in a manner consistent with e-sign. Subpart F under requirements is the safety and soundness requirements. 1. Banks must manage the risks associated with DCCs and DSAs. And 2. Banks must establish and maintain effective risk management and control processes over its DCCs and DSAs, including appropriate recognition and financial reporting of income, expenses, assets, and liabilities, appropriate treatment of losses associated with these products, and assessment of the adequacy of its internal controls and risk mitigation activities. There's some sample disclosures here on PDF page 99 of the long form, and I don't see one for the short form. I suppose I can read it. 1. This product is optional. Your purchase of the product is optional. Whether or not you purchase the product will not affect your application for credit or the terms of any existing credit arrangement you have with the bank. 2. Explanation of DCC product. If the product is activated, your duty to pay the loan principal and interest to the bank is only suspended. Note, explanation of debt suspension agreement applicable if the contract has a debt suspension feature. You must fully repay the loan after the period of suspension has expired. This includes interest accumulated during the period of suspension. Note, if applicable. 3. Amount of the fee for closing credit in parentheses. The total fee for the product is XX. For open-end credit, either 1 or 2. 1. The monthly fee for the product is based on your account balance each month multiplied by the unit cost, which is XXX, or the formula used to compute the fee is XXXX. X. 4. Lump sum payment of fee. Note to creditor. Applicable if bank offers the option to pay the fee in a single payment. Prohibited where debt subject to the contract is a residential mortgage loan. The verbiage is you may choose to pay the fee in a single lump sum or in monthly, quarterly payments. Adding the lump sum of the fee to the amount you borrow will increase the cost of the product name. Lump sum payment of fee with no refund. I'm not going to keep reading the creditor instructions. You have the option to purchase the product that includes a refund of the unearned portion of the fee if you terminate the contract or prepay the loan in full prior to the scheduled termination date. Prices of refund and no refund products may differ. Section called Refund of Fee Paid in Lump Sum. Either 1, 2, or 3. 1. You may cancel the product at any time and receive a refund, or you may cancel the product within 11 days and receive a full refund, or if you cancel, you will not receive a refund. And if the product is activated, you will be unable to incur additional charges on the credit card or use the credit line. Number 5, use of card or credit line restricted. Termination of product. Section, if you have no right to cancel, or if you have the right to cancel the product if in the following circumstances, and either, XXXX, and either 1 or 2, the bank has no right to cancel the product, or the bank has the right to cancel the product in the following circumstances, XXXXX. Just going to read the instructions for the last one because there was no text there. So use of credit card or credit line is restricted. Note, applicable if the contract restricts use of the card or credit line when customer activates protection. Back down to paper page 81. Last piece is the eligibility requirements, conditions, and exclusions. There are eligibility requirements, conditions, and exclusions that could prevent you from receiving benefits under the plan. The following is a summary of the eligibility requirements, conditions, and exclusions. Note the bank provides a summary of any eligibility requirements, conditions, and exclusions, or instead write the language, you may find a complete explanation of the eligibility requirements, conditions, and exclusions in paragraph 5 and 6 of the product name agreement. hopefully, okay, that's the last of the sample language.